So we were talking about debt to income last time we were talking to Mark, but I wanted to dive a little further into it for you guys to understand a little bit more. So there's two types of loans, conventional and FHA for most buyers. Can you talk about the limits of debt to income? You know, the what you're looking for from a debt to income ratio to really make that make sense.
Nerd. I love it.
Absolutely,
Okay.
absolutely.
So, a couple of things. In most mortgage companies, most loan officers probably aren't going to get into the weeds like this with you unless it's relevant because you're, pushing it to the limit. But there are certain limits that are set by the agencies. So, Fannie Mae and Freddie Mac have absolute limits for how much debt you're allowed to carry when you're qualifying for one of their loans. So does HUD for FHA loans. VA loans are a little bit more ethereal because the VA doesn't really have a hard limit. It's just whatever they'll approve. But in general, if you're getting a conventional loan, Fannie Mae's limit is 50%. So that means your total monthly debts that show up on your credit report, that's all your minimum payments, plus the new mortgage debt can't be more than 50% of your gross monthly income. If you're a W-2 employee, if you're self-employed, then it's actually the income that you pay taxes on. So whatever you report as your net income on your taxes. For Freddie Mac, that limit is actually 45%. So the limit's obviously lower for Freddie Mac, but there are some trade-offs, depending on your loan scenario, we may push it to a Freddie Mac loan just because Freddie Mac tends to be more favorable for self-employed borrowers. Especially if you have a business where the income's growing and you've been established for a while, Freddie Mac's a little bit more favorable. So you want to be mindful of that. There are additional overlays that individual lenders may have. So for example, if a lender tells you you cannot afford a house because it's outside of your price range, your debt to income ratio is too high, you want to find out if that's a guideline, which is the rules from Fannie or Freddie, or if it's an overlay, which means it's the lender's rules. Many lenders, especially the big banks, have overlays, meaning they want to limit their exposure to people who are more likely to default. Who are people that are more likely to default? People that are buying at the edge of their buying power, right? So if my maximum debt to income ratio that I can have for a Freddie Mac loan is 45%, and I'm going all the way up to 44.8, that's literally the most that I can afford. Big bank may not be comfortable with that. They may say, hey, we're limiting you to 41, 42%. Doesn't seem like a big deal, but when we're talking about transactions that are hundreds of thousands of dollars, that may be the difference between you being able to get the house you want or not. So you always want to ask those questions. FHA loans are a lot more flexible. You can actually go up to 56.9% debt to income ratio if you have credit over a 620 middle credit score. So if my 3 credit scores, Equifax, TransUnion, and Experian, the middle one's over a 620, I can get away with having way more debt with an FHA loan. Now there's some trade-offs that come with that. Obviously, we both know FHA loans aren't always the most favorable when you're in a competitive bid situation, but if you want maximum buying power, FHA loans generally are it. And you also have some extra allowance when it comes to your credit score. You can get away with having a lower credit score and still qualify for an FHA loan. And even though it's not really something that the agencies have come out and said, with conventional loans, it's actually gotten much more difficult over the last year, really since COVID hit, for people to qualify for conventional loans if you don't have phenomenal credit. So I've had clients who would normally be able to get a conventional loan, and I had to take them FHA just because their credit wasn't immaculate, or they had some dings on their credit from a couple of years ago, but it's still showing up when we're looking at that 2-year window. That's the most important window when you're applying for a home loan. In the last 2 years, maybe they had some late payments, and so that we had to take them FHA instead of going conventional. Well, in some ways it sucks because in a competitive bid situation, they're not looking as favorable, but they actually have more buying power because they're able to get away with a higher debt to income ratio. So be mindful of that. Lenders will definitely have overlays for FHA loans as well. And I know that's popular for you when you're working with clients that are buying 2, 3, and 4 unit properties, because to house hack and do a 3.5% down payment versus 20%, that's a big difference.
Right, absolutely, absolutely. So as you can tell, Mark knows what he's talking about. If you have any questions about loans, want to get the buying process started, direct message me. We can put you guys together and get everything going.
I love it.
Thanks, Mark.
Yeah.